Good Wednesday afternoon to you. Welcome to the John Sanchez Show on News Talk 780 KOH. It's a pleasure to be with you this Wednesday. Unfortunately, not a pleasure to have to tell you the news that I have to tell you regarding the market. Oh my goodness. Worst day of the entire year for the Dow Jones Industrial Average. Tough day. But as always, as I like to say, we're going to make it through it. I promise you that. Most importantly, it's for you to have a great understanding as to what happened, why it happened, and most importantly, to have a playbook going forward. And that's what I intend to help you do. With it being Wednesday, as I always promise you, I try to cover an estate planning topic, and I planned on that. I prepared for that. And the title, of course, of today's show was, when was the last time you looked at your trust? But I'm going to kind of put it to the sides again, because when I decided to have this as my topic today, that was, well, of course, before the stock market started to have its problems. So my number one priority, of course, with you this afternoon is to bring you up to date as to what happened. We had a Fed interest rate decision. To go through the details there, we had big earnings numbers out of Microsoft as well as Meta after the close, on top of the market sell-off. So lots and lots of things to discuss on the market side. Again, my number one priority with you. And so time permitting, I'll try to get to the estate planning issue. But if not, then I will definitely tackle it at a later time. Just a quick reminder, as estate planning topic is there, please join me for my webinar this evening. Can't wait to be with you at 6 o'clock tonight. We're going to be discussing, is your trust outdated, right? And it's not just about the date. We're going to go through the things you need to look at and what we can show you with our software to do a full analysis of your existing estate plan. Is it what you want it to be, right? Times change, your life changes. Let's highlight and make sure it's everything that you want. And so once again, the offer for those that want to join the webinar this evening, still, I think, 2 spots remaining for those that join. If you have an existing trust, I will perform a free trust analysis for you and tell you exactly what's going on in your trust. And then you can make the decision once again as to whether or not it's doing what you want it to do. Just go to my website, specializedtrust.com, upper right-hand corner, click on the Step Learning Institute, and you'll see in the drop-down webinars, and just click on that, and you'll see the sign up right there. So again, 6 p.m. tonight from 6 to 7, the live webinar with myself. All right, let's get down to the stock market side of things today. So we knew it was going to be a crazy day today, right? We knew we had 2 major earnings numbers come in after the close. We knew we were going to deal with that. We knew we were going to deal with, of course, the Fed interest rate decision. But what we didn't know we were going to deal with, of course, is late yesterday, and it was not long after the show ended, where the headlines came across indicating that Iran decided to be real idiots and fire upon us, of all things to do. You know, we'd had a nice, quiet, roughly 3 or 4 day time period where nothing really happened, right? The negotiations were going on. You heard the skepticism in my voice that the negotiations being led by Oman and backed by China. I was speculative of that from the beginning, and I hate to be right in a situation like this, but it just had it on, it didn't take a lot of common sense to realize that negotiation had nothing to do. It was going nowhere, but yet the market got excited about it, right? We had over a 500-point gain yesterday on the Dow, and oil prices tumbled over $5, and everything looked real good again until they decided to be idiots and launch missiles against us. And then, of course, they decided not only against us, but also Saudi Arabia. So we find ourselves back into a very interesting mess. Well, what we basically dealt with this morning was when the president, and Lord knows we don't blame him, he was doing an interview with Fox News, and he told the reporter that the U.S. will be hitting Iran hard. That's where his quotes, hard, in response to the surprise attacks on the troops in the Middle East. As soon as he said that, oil prices skyrocketed, stock market started to weaken, and then it continued to weaken and weaken and weaken. We also had pressure. This was, again, one of those days. This is just the same routine we go through. We have a day or so of good days in the chip sector, and then we have 2 or 3 bad days. And today was one of those bad days in the chip sector for really no specific reason other than just a weak overall market environment. So we didn't have anything that the street could really get excited about. So then we kind of languished. We were down 400 or 500 points on the Dow. And then we had the Fed interest rate decision. As anticipated, as I've been saying all along, and I said it this morning on the stock updates, there was roughly 70% probability the Fed was going to do nothing, and they did nothing. But once again, investors, large and small, are trying to get used to the mannerisms and reading in between the lines of the new Federal Reserve Chairman, Kevin Warsh. And I said this, when Powell had his last news conference, and I remember sitting behind this microphone and saying, it takes a while, right? It's like like it's like we're in the dating phase at this point. We haven't married the chairman yet. We're dating, and you're just trying to learn his little nuances. And if he says this, what does he really mean? It takes a while. It takes a number of Fed meetings, and usually, from what I recall, every time we get a new Fed chairman, it seems to take the street 6 months to a year before they really feel comfortable and really understand what this Fed chairman's all about. And I think we find ourselves in that situation. The Fed did, as I said, it did decide to leave interest rates unchanged, but the bond market rebounded with the 10-year yield jumping significantly, jumping 7 basis points to 4.67%. The 30-year bond yield soaring 10 basis points to 5.2%, highest level that we have seen in the 30-year dating back to the year 2000. So you see the street's immediate interpretation was, okay, interest rates left unchanged, but we've got a little problem. You see, we had 3 dissenters among the FOMC voters. 3 dissenters. 9 voted to leave interest rates unchanged. 3 wanted to raise interest rates. And the street decided to focus in on the 3 because experience shows us that when there's 3, then sooner or later there's going to be 5, and then maybe 7, and then maybe the entire quorum will decide that it's time to raise rates. The street is pricing in a September interest rate increase of 0.25%. I said this on the show yesterday with Dwight and Corey. So that was really the takeaway that we find ourselves in at this point is, all right, you got 3 dissenters where last meeting, his first meeting, it was a full majority saying, nope, leave interest rates unchanged. Now things are starting to weaken. The 3 officials that wanted a hike, again, Worse said the following: I want to stress, of course, that decisions by this committee matter a great deal, and where necessary and appropriate, we will not hesitate to act. And then Jeffrey Gundlach of DoubleLine, of course, very well-respected bond guru, he said on a CNBC interview, if you really want to get to 2%, he's referring to the 2% Fed mandate, I think you have to raise interest rates. He said the long bond yield went up significantly after the press conference because the bond market vigilantes are saying, if you really want us to believe your rhetoric, you've got to start acting. So now the street's kind of threatening the Fed to raise rates. So that was really the takeaway, and time permitting, I'll get into what the exact statement had to say when they announced the unchanged decision. But the real takeaway was, let's tempt the Fed. Now, a term that we have not used, or I have not used in quite some time, number of years, matter of fact, is called the Fed interest rate temper tantrum. And this is where the street can do it two ways. They can do as they're doing right now, where they're taunting the Fed, I guess is the best way to put it. They're taunting the Fed to raise interest rates. The other times, the Fed has rates high and the street's going, you need to lower these. And if you don't, we're going to sell the market off. Well, now they're using the excuse to sell the market off because they're taunting the Fed. And the street usually gets what it wants, if you think about it. Eventually, the street usually gets what it wants. Usually the street is correct in what it wants. So we find ourselves in a very interesting situation right now. I think the president, to be honest with you, finds himself in a very interesting situation. And I think it's a good time to kind of go back to the reminder is what's going on in Iran does affect what the Fed is doing, and they even said so. And I'll share with you in the Fed's statement, because back to the analogy I've shared with you many times, and that is higher oil prices create higher inflation. Higher inflation creates higher interest rates. Pretty simple, and vice versa. So unless the president can get this war situation under control, and something significant and something that lasts can happen, i.e. a ceasefire or some type of resolution, I think you're going to see the bond market, you're going to see the oil market and the commodity market really continue to play this game. But what I don't like what I'm seeing this time around, and I've been hinting about this, is the rise in yields overall. You see, it's not just the 10-year, it's not just the 30-year, it's yields overall. And that gets things nervous, because when you start to see a rising yield curve, right, where you have all the various maturities moving up in a very dramatic fashion, that just, to use my octopus analogy, that has tentacles that go into so many parts of not just our economy, but the global economy. So I think we got out lucky today, 2 basis point increase on the 10-year at 462, but that 30-year to yield of 414, remember, we're now at levels we haven't been at in years. And when the war really, picked up, roughly a month ago, we were at 517 on the 30-year, and the market didn't like it then. It's not liking it now to yield a 514 on the 10-year. So to kind of run across the board, what's interesting is the 2-year, which is very sensitive to what it thinks the Fed's going to do, the 2-year actually went down. So you would say, well, wait a minute. It lost 4 basis points on its yield to yield a 424. that's telling you the street's saying the Fed may cut rates. And yeah, that's kind of what the bond market in that sense is saying. You go to the 5-year, down 1 basis point, yield 435. And then that 30-year up 5 basis points at a yield of 514, as I said. And the 10-year up 2 basis points, yield 462. So to say the bond market's confused would be an understatement. It was just one of those days where so many cross currents happened between the Fed decision, the president's comments regarding gonna hit Iran hard, the rise in oil prices, and then of course the apprehension ahead of the earnings numbers from Microsoft and Meta after the close. And I'll give you a little hint: one did really good and one's doing absolutely terrible in the after hours. So I'll tell you how those stocks are performing as we continue our discussion on this Fed interest rate date. Back to the John Sanchez Show on News Talk 780 KOH. All right, let's get the news I've been dreading to give you, but let's get it out of the way. We got to talk about it if you already haven't seen. So once again, unfortunately, this ended up being the worst day performance-wise for the Dow Jones Industrial Average for all of 2026. Here's how we finished. 1,153 point loss on the Dow, down 2.19%. But the Dow closed in at 51,594. NASDAQ gave up 434 points, 1.74%, to close at 24,442. And the S&P 500 for the day down 113 points, 1.52%. Finished the day at 7,316. And I should mention the Russell 2000 lower by 1.61%, or about 47 points. So yes, it was a tough one. Here's what happened on the oil side. We finished up $5.16 on oil, 84.48 a barrel, and gold down down a dollar, down a dollar. So weird to say that. Down a dollar to close at $4,036.90. Just a few more comments regarding, the Fed side of things today. Again, they left interest rates unchanged. Kevin Warsh, of course, got a little testy a few times, as you wouldn't imagine, but he had one comment, and I'm trying to find it in the here it is. He said the Fed didn't have a magical ability to bring inflation down quickly. Quote, "I hear from you what I hear more broadly from households and businesses: impatience. Deliver it already," he told a reporter. "The suggestion that we're going to be able to do it with our magic wands is one I want to disabuse you and everyone else of." So he's recognizing the inflation, but he's saying, look, we don't have a magic wand. Now, remember, the last time the Fed got together, he was very adamant. He's creating basically 5 subcommittees of the Fed to look at interest rates. Remember, and I was kind of a smart aleck, I'll admit it, when he said, it is going to be no problem. We're not going to have any inflation in this country. And I'm paraphrasing. We're not going to have any inflation in this country in a year. And I said, wow, that's a bold statement to make. So the only way, in reality, the only way that can come true, the only way, is if the Fed gets on a very, very aggressive interest rate increasing cycle. But of course, that compounds and brings all kinds of additional problems, right? We hate it as a consumer. The business community hates it. Everybody hates it except for those that earn a yield on their savings accounts. But the other one that hates it, and you got to think about this, our next Fed meeting is I think August 15th and 16th. The other one that's going to hate it is the president. Why? Because midterm elections are right around the corner. And we all know how sensitive the president is to rising interest rates. We saw what happened with the criticism of Jerome Powell and some of the other Fed members and so on and so forth. But what's going to be interesting is to see, because he was very agnostic today. He did not put any pressure. He's still saying he loves Kevin Warsh and what he's doing and all that. But we all know this guy, meaning the president, he is not going to tolerate this for some time. And if he's fighting a war, which is weakening the equity markets, which is weakening the economy, which is driving oil prices higher, which means you and I are paying more at the pump, that could affect many people's voting. But also, if they're seeing their 401ks drop in value and their other investments, that could also affect their checkbook and therefore their voting of who they want. So I would be surprised if some criticism does not come out against Kevin Warsh, even though the president handpicked him at that August meeting where the street is anticipating a 0.25% increase. I'd be shocked if the president didn't come immediately out and criticize him. Now, the other way to look about it that no one's talking about, but this is just, the John Sanchez theory, is the president could be telling all of his advisors, get this war over with as quickly as possible at whatever expense other than making me look bad. Because if he doesn't, if these oil prices continue to rise, And again, we shot up, and then we've had a nice pullback. Remember, we were down over 69. We were a little below $69 a barrel just a few days ago. And once again, here we are, knocking on the door of $85 oil. But if he doesn't get these oil prices down, these inflationary reports, because you got to remember this, the Fed basically has a month and a half of economic data to digest before their next meeting. If the economic data reflects inflation increasing, they're going to be very, very inclined, not just 3 voting members, but maybe the majority and maybe even the chairman himself, to give us that interest rate increase that so many on the street want to curb inflation. So it's a quandary. It really is a quandary, and that's why I wanted to spend a little bit of extra time with you, explaining what Wall Street is kind of looking at from this perspective. Because if this war, like I said, it gets extended and oil prices rise, it's going to have an impact on inflation. Impact on inflation means the Fed will have no choice but to raise interest rates at that August meeting. But let's be optimistic. Let's look at the other side. Let's say a ceasefire is reached, God willing, and oil prices come down. Once again, we've got a month and a half of economic data for the Fed to digest. That could be enough time to start to get some of the inflationary down, the CPI, the PPI, the PCE, et cetera, all the Fed's measures of inflation. So this, essentially this next month and a half, going to be very critical on the war front, going to be very, very critical on the interest rate front. Now we come back. I want to share with you what the Fed did have to say at the release of the FOMC meeting, and then we'll move into Microsoft and Meta's earnings numbers after the close. Check. Come back to the John Sanchez Show on News Talk 780 KOH. All right, so once again, if you just joined us, bring you up to date on a tough day that we had. 1,153 point decline on the Dow, 2.19%. Worst sell-off of the entire year. We closed at 51,594. NASDAQ gave up 434 points, 1.74%, and the S&P lost 113 points, 1.52%. All right, so we had rising oil prices. Again, oil shooting up over $5 up $5.16 to $84.48 a barrel. We had interest rates for the most part rise. We had a Fed interest rate decision where they left rates unchanged, which I'll share with you in just a moment what they had to say at the meeting, which was literally identical in the press release of the June's meeting. And then, of course, the anticipation of 2 major tech heavyweights reporting after the close. All right, so before I get to Microsoft and Meta's earnings and what they're doing in the after-hour session, let me quickly read to you what the Fed did have to say today in the meetings, the comments after the meetings. So, like I said, it was literally identical to what they had to say at the June meeting. The committee decided to maintain the target range for the Fed funds rate at 3.5 to 3.75% in support of the Federal Reserve's dual mandate. The committee is continuing its policy of maintaining ample reserves in the banking system. Was comforting to know. Economic activity is expanding at a solid pace despite elevated uncertainties that owes, in part, to the conflict in the Middle East. There's my comment. Productivity growth and capital investments are strong. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated to the committee's 2% goal, in part reflecting supply shocks that have driven price increases in certain sectors, including energy. The committee will deliver price stability. That's it. See how he's really shrunk this thing down, meaning Kevin Morris. Like I said, this was identical to the June's meeting. And once again, we had 3 dissenters voting for a 0.25% increase. That was Beth Hemmick, Neil Kashkari, and Lori Logan from Dallas. So there's where we are. We'll see. Again, no time yet by any means. No time for panic. We will see how the market reacts tomorrow to give it a chance to digest this situation with the Fed, as well as what I'm about to share with you now, which is the earnings releases of Meta and, of course, of Microsoft. So we find ourselves in a very interesting situation from the standpoint of the market loves AI, the market loves data centers, but they don't like the companies to pay for them. Plain and simple. Coming into this meeting, this was again one of those coming into these earnings numbers, this was one of those where everyone was very, very concerned in regards to the capital expenditures. So 2 factors, I should say. The capital expenditures as well as the cash flow. Now, remember, when Google reported last week, Google reported negative cash flow because of the amount of money they are spending. First time ever in history, negative cash flow. So that's why these 2 stocks were, again, skating on thin ice. Okay, let's get the bad news out of the way, which is Meta. Microsoft doing pretty well. Meta having some problems in the after hours. So in the regular session, Meta finished the day down $7.80, 1.31% to 585.61. After hours, right now the stock, which when I started the show was down over, I think $53, if I remember right. Right now it's down $44.96, 7.68% loss to $540.65. So now you see the street's reaction. So let's get down to the numbers. Big capital expenditure. I'll just kind of give you the warning there, but let's hit the details. Earnings came in at only $6.18 a share. Street estimate was $7.22 a share. Revenue was a slight beat, $60.8 billion. Estimates $60.17 billion. Meta said they expect revenue this quarter of between $61 billion to $64 billion. So again, that'd be slightly higher than the previous quarter, or about $62.5 billion in the mid-range. Analysts were looking for a guidance of 63.1. Now, the company said the guidance assumes foreign currency is an approximate 1% headwind to year-over-year total growth based upon the current exchange rates. Daily active people, or what they call DAP, came in at $3.6 billion, trailing Wall Street's estimate of $3.61 billion. DAP measures the number of users of Meta's family of apps. Now, to the granddaddy of the report, the capital expenditures. Meta narrowed their guidance for the year to between $130 billion to $140 billion of capital expenditure from a prior range of $125 billion to $145 billion. So you see slight uptick. With Meta pouring money into AI infrastructure, their free cash flow dwindled. This is a staggering number, folks. A year earlier, Meta's free cash flow was $8.55 billion. Let me repeat that. Free cash flow, $8.55 billion. The company said now it is only $784 million. Staggering. Coming into today's close, Meta shares down about 11% for the year. And then, of course, we got this after hours going on, so that's going to pressure that even more. Now, remember, earlier this month, Meta debuted Muse Spark 1.1 model, which the new AI chief Alexander Wang said represents the strongest model for agentic encoding work yet, and at a cheaper price than offerings from OpenAI and Anthropic. The company's been aggressively investing in new AI strategies since hiring Wang back in June of 2025 in a deal that involved a $14.3 billion investment in Scale AI, which, oh, by the way, is Wang's startup. Last week, as I said, Alphabet reported that free cash flow turned negative for the first time on record due to the internet giant's hefty AI spending. But unlike Alphabet, fellow hyperscalers like Amazon and Microsoft, Meta does not have a thriving cloud computing business to kind of balance things out. Company could be changing as Meta looks to lease out excess capacity to third parties. Zuckerberg said on the call, "We're getting a lot of offers for compute at a significant premium over what we paid for it." On the call, Meta also announced a venture with BlackRock to create a $14 billion data center project in El Paso, Texas, just weeks after disclosing that its big Hyperion data center project in rural Louisiana would cost over $50 billion. Earlier this month, Meta revealed plans to build a $9 billion data center in Alberta, Canada. Meta said second quarter total costs and expenses came in at $42.03 billion, representing an increase, listen closely, folks, of 55 total costs and expenses, increase of 55% from a year ago. That figure includes $2.4 billion of charges related to legal proceedings and $1.18 billion of severance expenses in connection with the company's layoff that began in May. The finance chief, Susan Lee, said on the call that excluding those charges, operating income would have increased 9% year over year. Net income for the period sliding to $15.85 billion from $18.34 billion, or $7.14 a share in the same period, in the same quarter a year ago. Meta's Reality Labs generated $4.6 billion in the second quarter operating losses while bringing in $431 million in sales. $4.6 billion in quarterly losses and only bringing in $430 million in sales. Wall Street was expecting that unit, which develops virtual reality and related AI-powered wearable devices, to record a second quarter loss of $5.07 billion on revenue of $423.4. So a little bit of a miss there. All right, so there's the situation on Meta. Now let's turn it over to the other big earnings release after the close, which of course was Microsoft. Now let me tell you what the stock is doing currently in the after hours. First, how it did in the regular session. Stock finished down $2.81, 0.71% loss to $390.54. After hours right now, it is doing very well, up $33, 8.48% gain to now a price of $423.67. So doing very well there. Now let's kind of get over to some of the details. So on the earnings per share side, they came in at adjusted $4.74. That may not compare with the $4.24 expected by analysts. And I'm not sure why they're stating that, but big beat, but they're saying it may not compare. Revenue for the quarter, $90.01 billion. Estimates were $87.62 billion, so a little bit of a beat there. The revenue grew about 18% year over year in the quarter, which ended on June 30th. Net income of $35.77 billion, or $4.81 a share, increased from $27.23 billion, or $3.65 a share in the same quarter a year ago. Microsoft cited a $3.2 billion gain from its investments in artificial lab Anthropic and lower than expected costs tied to its first ever voluntary retirement program. Meanwhile, its Xbox gaming business received an impairment charge. As of the close today, the company's shares are up about 19% so far this year. S&P, of course, up about 7%. Meanwhile, Microsoft is confronting some concentration risk with its OpenAI relationship, especially with the ascent of open source models. That's according to a Deutsche Bank analyst who recommended buying Microsoft stock in a note last week. Microsoft said in January that around 45% of its $625 billion in commercial remaining performance obligations were tied to OpenAI. When it comes to allocating computing capacity, their CEO, Mr. Nadella, has been trying to balance the needs of the Azure cloud, which is theirs, the research and applications such as Microsoft 365 Copilot Assistant. If researchers get a hold of more AI chips for model training, that means fewer will be available for cloud client. Let's see, capital expenditures and finance leases for the quarter, $41 billion, an increase of 69%. Their finance chief, Amy Hood, reiterated plans for 2026 capital spending, but the company said it will lengthen the useful life of office and data center buildings. Listen to this one. This is a little accounting maneuver here. So they're gonna lengthen the useful life. And let me stop right there. Why is this important? Why am I laughing? This is the game a lot of these tech companies have been playing. I've covered this before. So instead of writing off a GPU, an office, a data center, etc., over the IRS's recommended time period, they're extending it because they feel that it lasts. Wall Street, however, says, wait a minute here. Technology is changing all the time. These data centers are not going to exist in, 10 years at the most, in my opinion. They're going to be probably mini storage facilities because technology is going to change. We're not going to need data centers. So when you extend the life of them, what you're doing is you're decreasing the depreciation expense that you're going to take on your income statement. By decreasing the depreciation expense, it increases your earnings per share. Hence a little accounting game there. So back to what they said. Companies said they're going to lengthen the useful life of office and data center buildings to 25 years from 15. That is significant. And more future data center leases will change over to operating leases from finance leases. Another little balance sheet move. The adjustment's going to lead, here you go, to roughly $175 billion in CapEx spending. And finally, for the 2027 fiscal year, Amy Hood said she sees further growth in capital expenditures, pointing to, quote, demand signals across our portfolio. Free cash flow, $19.64 billion, plummeting 23%. All right, so there's how we're doing. I'll tell you how the market is performing in the after-hour session as futures started trading less than an hour ago when we come back, and then we'll begin to wrap things up. Welcome back to the John Sanchez Show on News Talk 780 KOH. All right, one more time to get the painful news out of the way. How we finished: 153-point decline in the Dow. Nasdaq lost 434. It hurts to say that, and the S&P lower by 113. But I've got a little bit of bright news for you, and that is what we're seeing going on in the after-hour session at this point. So let's hope this continues and builds overnight. Right now, we're seeing the Dow futures up 128, Nasdaq's gaining 103, and the S&P's up 19. See? I told you not to panic. All right. So once again, here we find ourselves at the end of the show. I want to give you a quick reminder of what I'm going to be doing at 6 p.m. because I'd really love for you to join me. Once again, I'm going to be holding an educational webinar for you this evening at 6 p.m. And we're going to be talking about, again, something that I am seeing, and this is why I wanted to do this webinar, because I'm seeing this so very, very frequently in our new business, specialized trust and estate plans. And that is people spent the time, the money, the energy, and thought they had peace of mind when they had their living trust created. But in reality, it may be a falsehood because so many people think that once they sign their trust, it's done. I never need to touch it again. I've literally had people show me their trust in their, big fancy binder and they blow the dust off of it. That's the way mine is or was. Literally had it shoved in a cabinet, never took a look at it, couldn't understand what was going on. Well, I fixed all that. the way we've designed this business. But again, once people believe that they've signed the trust, that they're finished, put it on the shelf. But it's not the case, because the point I try to get across to people, and this is where I'm going to get into some great detail this evening at the on the webinar, is the trust isn't just a legal document. It is an absolute reflection of your life and your family. And you can't tell me, if we look eye to eye to one another, that your life hasn't changed over the last 6 months, year, 3 years, 5 years, 10 years, or however long it's been since you had your trust created. Of course, your life has changed. Our lives change each and every day, basically. So there's a great chance that how you created your trust, it was perfect when you had it done originally, but your life has changed, but your trust hasn't. So therefore, you're going to find yourself in situations where it hasn't kept up with the latest tax laws. You don't have the beneficiaries in there. You don't have the same people that you've delegated to be your agents of your medical directive and your financial power of attorney. Those people maybe died, moved out of town. And again, even your successor trustee, which is the one that you've entrusted to handle your estate when you're gone, they're no longer around. So again, the bones of the trust may be great, but your life has changed and the trust hasn't. And you're not going to know until you're looking down from heaven and going, oh my gosh, I have left my family a mess. I do not want to see that happen to any of you. So that's why I'm inviting you to join me at 6 p.m. tonight. You can still make your reservation at specializedtrust.com. Again, just click on the Step Learning Institute in the upper right. This is where I have a bunch of articles and educational material for you. You'll see the webinars, and just open down the drop down. And as your trust outdated, you'll see the sign up there. And again, no charge, no nothing. We are booked up on the number of people, again, that I've offered to do a free estate plan review for. I had that limited to 25 people. So that's all taken care of. But I promise you, you're going to walk away with a lot of information. I'll give you a little taste of what we're going to be talking about. I'm going to start things off by really talking about life doesn't stand still, and neither should your estate plan. I'll be talking about the biggest estate planning myth that is out there. Does your trust still reflect your wishes? And estate planning is really life planning. Just a few of the things I'll be discussing. So if you have an existing estate plan, not sure if it's still what you want it to be, join the webinar. I'm going to give you a bunch of things that you can look at yourself and go, oh, this could be a problem. This isn't where I want it. Got unfunded assets and so on and so forth. And then we can talk. Or you can go get it done on your own, take it back to your attorney, whatever you want. I just want you to have an up-to-date trust that reflects you and your family's wishes. I'll see all of you at 6 o'clock. Once again, go to specializedtrust.com, click on Step Learning Institute, and sign up for the webinar. God bless. Have a great afternoon. We'll see you tomorrow on the John Sanchez Show.